Got to wonder about that consumer, maybe, especially in places like Silicon Valley, whose pay is largely in stock, 100%. Who's seen that come down. Maybe they decide they don't need that remodel after all, and that backlog doesn't end up looking like we expect it to. Okay, now on the companies themselves. We've talked a lot over the last couple years, really, about how they've built up digital capability and what that might do for loyalty down the line. So even as Walmart takes this short-term hit on margins, not passing all of those prices through to consumers, are they going to be able to benefit by having a larger share of wallet with that customer because of the investments they've made in the digital business?
Yeah, you know, it's funny. Traditional retail, which was presumed dead 5-6 years ago, and we've always argued that you can't count these businesses and these companies out. I think our business has taken a lot more share in digital, whether that's digital advertising. Walmart's digital advertising business was up 30%. We expect Target's digital advertising business to grow up 30%. And on that share of wallet, the one I'm most bullish about, frankly, is Target, in terms of they have the best traffic, they have fewer competitors post-COVID, they have a higher-end customer relative to Walmart, and they've been taking share across the box, with digital, particularly their drive-up curbside business, being a major enabler of that.
So if, therefore, some of these retailers are going to have an ugly look, I mean, we see, again, Walmart down 10.5% so far today. Is the market, you think, pricing in that digital loyalty benefit that some of these retailers might show longer term? Is there opportunity buying at these levels, or do you need to stay away because you expect that extra leg down from the better off consumer who's going to be affected by these interest rate hikes?
Yeah, stepping back on retail, it's just not a late cycle sector. One, we don't like interest rate increases because that burdens the consumer. It discounts the stock to a lower price. The second thing is, what's unique about late cycle is the top line slows and the cost structure inflation accelerates. And that's exactly what you're seeing with Walmart. So earnings revisions after 2 years where all these companies were COVID winners, earnings revisions are now going from sharply up to flat. And in this case, in Walmart's case, down. And that's just not good for stocks.
Finally, what do we learn about labor from these two reports, particularly Walmart? Walmart talked about people coming back from COVID more quickly than expected and actually being overstaffed, which is not a word we're used to hearing in this economy.
Yeah, you're hearing, it's interesting because you also heard from Amazon as well. You're hearing that change where heretofore we had a hard time filling positions. People were staying away because of COVID. People were staying away because of stimulus. Well, as you entered into 2022, the child tax credit went away, SNAP benefits receded. We lacked all the stimulus dollars, both from the January checks as well as the March checks. So that consumer is being forced to start to go back to work. And you're seeing that in Walmart's numbers. You're still running very high single-digit sort of wage inflation in retail, and more so actually for the overall consumer. But we would expect that to cool down over the year. And again, I think it's a bit early to really try to get more bullish on retailers, given all of these dynamics. Let's see when the Fed sort of yields, so to speak, and at the same time when we start to see estimate revisions downward on 2023. I think we need to get some of that in the stocks before we go out and start to buy opportunistically.
Well, it's sobering, but that makes sense. Chris Horvers, thank you.
Thanks, John.
JPMorgan.